Alright, so now let's talk about the clientele effect. Now, different groups of investors or clienteles prefer different dividend policies. Does this make sense? So if you are a retired widow, okay, and you rely on your income from investments, what sort of stocks would you prefer? Then you would prefer income paying or dividend paying stocks. Now, so now take a company like 4G Fertilizer. Who are the sorts of people that typically invest in 4G Fertilizer stock? It's people who want the income, who want the dividend. So what is the 4G Fertilizer stock clientele? It is the people who want dividend. Now, a firm's past dividend policy determines its current clientele. So given 4G Fertilizer's dividend policy, that is what determines the clientele that stock has. Clientele effects impede changing dividend policy. Taxes and brokerage costs hurt investors who have to switch companies. Now, if 4G Fertilizer were to suddenly change its policy and say that now we will stop paying dividends because we are on a growth track, would the investors who own 4G Fertilizer stock, would they appreciate that? No, why not? Because then they have to go sell the stock, buy other stock. Does that take time and money? It does. You have to pay brokerage fees and then pay taxes maybe. So obviously once a company has a certain dividend policy, then there is sort of, to use another term, there is a switching cost. Have you heard that term, switching cost? So while it's not typically used in this context, but in a sense there is a switching cost both for the investors, and then companies also don't want to annoy their shareholders. Okay. Now we are going to talk about a model called the residual dividend model. Take a wild guess. What do you, just based on this name, Anushe, what do you think this model means? What do you think? How do you think this model will work? So let me help you. So residual, what does residual mean? Residue? Residue is something that is left behind. Okay, so now when a company makes money through earnings, what do you think the company would like to spend that money on? Projects, exactly. So remember capital budgeting? What happened in that? You figured out what projects to spend money on. Where does the money come from? Yeah, so ideally you would want that the earnings that you generate are used to pay for your projects. Then when the money that you earn, you use on projects, what if money is left over? What do you think that money is called? That's the residue. Okay, and then now what do you think the residual dividend policy would mean? No, first you have to answer my question. Can you repeat the question? Loudly. Okay, so here is the bottom line. So find the retained earnings needed for capital budget. So let's say a company makes earnings equal to 100. And let's say that for your capital budgeting, for your projects, you need 60. What's the residue? 40. Pay that out as dividends. That's the residual dividend policy. So if your dividend is 40, what are you saying? You are saying, okay, I make money, that's my earnings. My first priority is to fund my projects. That's 60. The residue is 40. I pay my residue out as dividend. That policy of paying, of first doing my projects with my earnings and then paying the rest out as dividend, that policy is called a residual dividend policy. Does it all make sense now? Does this look like a logical policy? It looks logical, but it has issues that we'll discuss later, but at least from a theoretical perspective, it is appealing, right? The policy minimizes flotation costs and equity signaling costs. Let's say managers don't like to send out too many signals, right? So then, and managers don't like to incur flotation costs. Given these two items, does it make sense that managers like the residual dividend policy? Yeah, no, as in the company is expanding, that's why it needs to spend money on these projects. So it has retained earnings. What's the retention ratio for this simple example? Well, the company, what's the first priority when a company makes 100 million, what's the first priority? The first priority is to spend money on the projects that are good. Okay, so those projects are projects that are helping the company grow. And then the residual is paid out as dividends. If the company, in my simple example, if it determined that it needs to do projects worth 100 million, then what would the dividend be? Then it would be 0. So is a company first paying dividend and then seeing what's left? Or is a company first spending on the projects and then seeing what's left? Yeah, it's first spending on the projects and then the residue. So what's the residue in this context, Anusha? Yeah, but what's the definition of residue? Yeah, it's actually the residue of the earnings. Earnings are first spent on the budget, and then what's left is so the dividend is a residue. You get it? Okay. So now let's get a little more formal. What's the residual dividend model? So this is where dividends are equal to net income minus target equity ratio multiplied by total capital budget. Now I want you to stare at this for a couple of minutes and try to make sense of this. Okay, so do you understand this? How many people understand this? Okay, so a partial group partially understands this. Let's see how this goes. Okay, what this formula is telling us is how much dividends need to be paid out. Now, clearly the amount of dividend that is paid out, do you think it should depend on net income? It should depend on net income. So let's say net income is 600,000. Okay, then assume that your capital budget is 800,000. What does this mean, Saad? Yeah, so you plan to do projects to enable your growth or to sustain your current growth rate. You need to spend $800,000. Now, will this entire 800,000 come from equity, or will it be partly debt, partly equity? So it will be partly debt, partly equity. How do you figure out? How do you figure out how much of this will be debt, how much will be equity? Exactly. This comes from where? This is your capital structure. So your target capital structure, let's say, is 40% debt and 60% equity. So given that target capital structure, what should the debt be? Yeah, so 40% of 800, which is 320,000. And what should your equity be? Okay, do you understand this? So the amount of money from equity is 480. If you take your entire net income and put it into this, what will happen? That will sort of hurt your capital structure. To maintain this capital structure, you need to use debt and equity in the ratio that corresponds to your target capital structure. If you don't do that, what will happen? Then your capital structure will change. Okay, but we are given this capital structure. So do you notice what we are doing here? So target equity ratio in my example is what? Okay, why? Somebody said so. Okay, so the target equity ratio is 60% multiplied by total capital budget. What's the total capital budget? Okay, so what's the dividend now? What's the dividend? So the dividend would be simply that simple math. So your the money that you need from equity is 480,000. Your net income is 600,000. So the residual is, and that's how much you pay out as dividend. Okay. So what's going on here? So is this what we just did? This is what we just did. We calculated the 120,000. Okay. What's the payout ratio? Yeah, in this particular case, the payout ratio is the dividend divided by the net income. Can you do this? So let's see how many people can solve this one. Alright, so what's going on here is, okay, if the net income falls, then the dividend is, so the point is you can't pay out a negative number, so the dividend in this simplistic case would be 0. But what do you think a company would do if it wants to maintain its same capital structure? Then what would it have to do? It would issue new shares. New shares worth how much? Okay, so So the point is your capital budget to maintain that ratio is still 480,000. So it will use all this 400 as what? So that would be retained. So what's our retention ratio now? 100% payout would be 0, and a company would go and raise 80,000 by issuing new shares if it wants to maintain the same capital structure. What if net income is 800,000? Then the dividends will be more. So do you okay, so let's continue and then I'll get to some other points. How would a change in investment opportunities impact the dividend? If you have fewer good investments, then that would lead to a smaller capital budget and hence to a higher dividend payout. More good investments would lead to a lower payout, and that's what we discussed at the start of this class. Okay, so now what do you think are the pros and cons of a residual dividend policy? One advantage is staring at you. It minimizes new stock issuance costs, so flotation costs are low. Anybody who is sharp enough to try and think of any disadvantages of this model? Exactly. So a huge issue would be fluctuating dividends. Why? Because with your earnings changing or your capital budget changing, what will happen to the dividends? Dividends would also fluctuate. So disadvantage, it results in variable dividends, sends conflicting signals, increases risk, and doesn't appeal to a specific clientele. Okay. So what is the core point here, or the concluding remark? That you should consider the residual dividend policy when setting target payout, but don't follow it rigidly. You need to generally think about how much dividends you'll be paying out, but if you follow it rigidly, then your dividends would be extremely volatile. Do you think your clientele will like that? No, stockholders will not like the fact that they cannot predict what sort of dividends they are getting. Okay, so setting dividend policy. Here is one example of how companies go about setting their dividend policy. So they will forecast their capital needs over a planning horizon such as 5 years. Okay, so how much money will we need over the next 5 years? What else do you think they will consider? Exactly. They'll also consider their capital structure. How much of the new projects do we want to fund from equity, our own money? How much do we want to fund from debt? Okay, then we will estimate our equity needs based on this. Okay, set target payout based, now not explicitly mentioned over here, but what is quite obvious is you also need to forecast how much your net income will be over the upcoming years. Okay, generally some dividend growth rate emerges. You try to maintain a target growth rate if possible, and varying your capital structure somewhat if necessary. So clearly this is not an exact science, but you are trying to balance 2 or 3 variables here. What are those 2 or 3 variables? Generally companies like to pay a stable dividend, and generally companies like to have some growth in their dividend. At the same time, companies want that as to whatever extent possible, or at least to the extent that the capital structure demands, companies use earnings, their own earnings, to pay for their projects. So you try to balance all these variables in coming up with your dividend policy. Now at this stage we won't get into more details on this. Hopefully you got the big picture. Okay, a few other general points. Stock repurchases. What are stock repurchases? Yeah, is this sort of like a dividend? What are the similarities and differences between a stock repurchase and a dividend? Exactly, very good. The similarity is in both cases you are giving the investor some money. What are any other comment? Exactly, then who is the new owner? The company. Does anybody know the name of that transaction when a company buys back? This is also called a treasury stock operation. Okay, a treasury stock operation, shares are bought back. What happens to the equity of a company when shares are bought back? The equity goes down. So what's the basic accounting entry when you buy back shares? Does anybody know that? Yeah. So cash goes down and equity also goes down. So in a treasury stock operation, you are using your own company money to buy back shares. So your company money goes down and the equity goes down. Why might a company repurchase? As an alternative to distributing cash as dividends. Okay, so when a company distributes cash as dividend, it is sending out a signal that we are paying these dividends, and what is the expectation that is set with the clientele? That we'll be getting this sort of dividends in the future. Now, if a company just happens to have a lot of cash one-off and doesn't want to set expectations, doesn't want to set a precedent, then is it more logical to pay out that as cash dividend or to buy back shares? Then it makes more sense to buy back shares, because when a company buys back shares, then it is not setting a precedent, it's not setting an expectation that we'll be paying more dividends. So the question is, does the company downsize when it buys back shares? The point is that what is happening is the size of equity is coming down. Okay, so in a sense, the company is becoming smaller. Why? Are the assets coming down of the company? Cash is a major asset. So in a sense, the company is becoming smaller. Both sides of the balance sheet are becoming smaller. Typically, you measure the size of a company based on what? Either market cap, but the most objective or basic item is the total assets. A company is becoming smaller because total assets is going down, and on the right side of the balance sheet, your total equity or capital is also coming down. Okay. If a company just has cash one-off because it sold off a business, right, or it had a major profit in a given year that is not likely to be sustainable, and it doesn't have profitable projects, what's the logical thing to do? Buy back shares. What's another advantage of share buyback? That your number of shares outstanding goes down. So if you have extra cash and you buy back shares, what will happen to earnings per share? Earnings per share can go up. As long as you are just using idle cash to buy back shares, your earnings per share will go up. You can also do this. Do you recall in a reading on capital structure, we changed the capital structure by buying back shares? In that particular case, we borrowed money, so debt went up, and then we bought back shares, so equity went down. In this case, what are we talking about? If company has extra cash that it makes through its own operations or by selling a business or selling some unit, then that cash, if that cash is used to buy back shares, is the capital structure changing? Even then the capital structure is changing, because if the percentage of equity is going down, then still the ratio of debt equity will change. Okay, what are the advantages of repurchases? Shareholders can decide whether to tender, which means from a shareholder perspective, shareholders are doing what? They are selling their shares. So shareholders have a choice to sell or not to sell. It helps avoid setting a high dividend that cannot be maintained. So we've talked about that. Repurchase stock can be used in takeovers or resold to raise cash as needed. Okay, so all this is saying is that when company has bought back shares, it can issue those shares to buy other companies. I'll say this very briefly. If you understand it, great. If you don't understand, not such a big deal. Have you ever heard in mergers and acquisitions that a company buys another company? Let's say that you have Faisal Bank buying RBS, and I don't recall the exact details of this transaction, but Faisal Bank, broadly speaking, has two ways of buying RBS. One is it can go to all the RBS shareholders and pay a certain number of rupees per share. This is called a cash transaction. Another transaction can be where Faisal Bank says that for every share of RBS, we will give you Faisal Bank shares. So, for example, for one RBS share, we will give you one Faisal Bank share, just as an example. Okay, now where do these shares come from? They don't just pop out of nowhere, right? So it's the shares that Faisal Bank has, so new shares that it can issue. So if Faisal Bank has bought back shares, it can then reissue those shares and give them to RBS shareholders in order to buy RBS. Okay, this is a more advanced topic that you can study in mergers and acquisitions, but at least you have a high-level understanding right now. Income received by shareholders is capital gains rather than dividends, which generally involve higher taxes. Shareholders may take as a positive signal that management thinks stock is undervalued. The point here is, when management buys back shares, what sort of a signal is going out? Who knows best whether a given stock is overvalued or undervalued? Management. So if management is buying a share, would management buy its own shares if they thought the shares are way overvalued? No. So you as investors get a positive signal that if management is buying their own shares, then they must think they must think that the shares are undervalued. Okay. What are some disadvantages? Okay. So the other side of the coin is, if management is buying back shares, that means management doesn't have good things to do with their money. Right? Why else would they be spending their money to buy back shares? So is that a positive signal or a negative signal? So that's a potential negative signal. Okay, now this is US centric, but you know what IRS is? It's the Internal Revenue Service, that's the tax authority. So they could impose penalties if repurchases are to avoid taxes on dividends. Okay. Stock sellers may not be well informed, hence they may be treated unfairly. So the point here is, the transaction is between whom and whom? The company and the stockholders. Who has more information? The company. So stockholders might be treated unfairly, somewhat vague, but stockholders might then raise the price and say, we don't want to sell, we'll sell at a higher price, which makes it more expensive for the company. Okay, now slightly different topic. Stock dividends. What's a stock dividend? A stock dividend is also called, these are also called bonus shares. So if you own 100 shares of FFC, and let's say FFC announces a 20% bonus. What does a 20% stock bonus or 20% stock dividend? What do you think this means? Yeah, for every 100 shares you get 20. So if initially each share was worth rupees 200, then you get 20% more shares. What's your new wealth? How much was your original wealth? What was your original net worth based on this times this? 20,000. Now that you got 20% more shares, what's your wealth? So just new money was created out of nowhere. Yeah, the price will fall. You don't become any richer when new shares are issued. Okay, the total wealth stays the same. How many shares do you now have? You have 120, and what's the new share price? It will be 20,000 divided by 120. So your net worth stays the same. This is a stock dividend, so no reason to get overly excited when you get extra shares. It's just that you have more shares, but each share is worth less. Okay, somewhat similar to a stock dividend is a stock split. In a stock split, you can have, say, a 2-for-1 split, where if each share was worth 200, now that is converted into 2 stocks worth 100 each. So are you any richer? No. Now you have 200 shares, and each share is worth 100, so your net worth is still 20,000. Then what question should be popping up in your mind right now? Why go through all this? Now, companies typically try to maintain their stock price in a given range. If a company is doing well, what will happen to the stock price? Keep going up. Would you like to buy shares of a company where each share is worth, let's say, $20,000? No. If Microsoft had never split, each share would probably be worth $20,000, $30,000 today. Okay, how many people would go and buy one share for $30,000? Very few. Okay, now to maintain stock price in a range, then what can companies do? They can either give stock dividends or they can have splits. Okay, is there any difference between a 2-for-1 between a stock split and a stock dividend conceptually? From a finance perspective, there is no difference. From a accounting perspective, there are subtle differences in terms of how you account for par value and so on. But since this is not an accounting course, we will not go into those differences. As far as we are concerned, from an analytical perspective, basic finance perspective, they are effectively similar. Okay. So both stock dividends and stock splits increase the number of shares outstanding. So in essence, the pie is divided into smaller pieces. Unless the stock dividend or split conveys information or is accompanied by another event like higher dividends, the stock price falls so as to keep each investor's wealth unchanged. Okay, splits and dividends may get us to an optimal price range. Optimal price range of what? Of the stocks, exactly. When and why should a firm consider splitting its stock? So in the US, firms try to maintain their stock price between 20 and 80. So if the stock price is going too high, then they will split. Stock splits generally occur when management is confident, so these are generally interpreted as a positive signal. On average, stocks tend to outperform the market in the year following a split. That's just, why do you think this is? Partly psychological, but partly if I am a company and my stock is splitting, I'm sending out a signal that I think the stock will keep going up. Okay, now the last point, I mentioned this earlier. What's a dividend reinvestment plan? This is where shareholders are given an opportunity to reinvest the dividend. So this ties back to the concept of a homemade dividend. What's a homemade dividend? Yeah, so with the dividend you buy back shares. Now, if you, rather than you doing this on your own, you can just tell the company that, look, whatever dividend you are paying me, just use that to buy back shares for me. Okay, so this is called a dividend reinvestment plan. You don't need to worry about the different kinds of plans. All I want you to know is this terminology.